Hello, everyone. Thank you for joining me. Welcome to accounting, which is part of our financial management module. I hope that you are well prepared. And I know most people, when they think of accounting, they think of the mathematics. They always say, where do I even start? I'm not good with numbers. Let me tell you something. You are. Only if you knew, you are. You just need a little bit of an effort. Attempt to force yourself to try. No one is perfect. Don't just say, I don't want to be the sort of a person that is good with numbers. No. Don't say, that's not who I am. My preference lie elsewhere. This is not a priority for me. I'm not prepared to sacrifice other things to pay attention to this. I don't have time. Please refrain from doing that. So accounting is doable. So let's make sure that we commit ourselves. Let's make sure that we engage with the material. Check my video so that you can be able to understand better. Okay. So please make sure that you focus. Once you have decided that you are not good at something, you know that the mental block that develops is very powerful. So make sure that you refrain from doing that. Okay. So make sure that you study the material and then please check my notes, and I'm gonna upload more notes as from now on. Without wasting time, let's continue. My name is Sylvester Simono. Some of you have met me, you know me. This is my contact details, guys. You can even check me on YouTube. My YouTube is very active. You can check there at your own, spare time, just interacting with me. Okay. I hope that everyone is following. I just want to talk about accounting. Please make sure that you engage with your material. Remember, the slides and the videos are just trying to summarize whatever is in your manual. You know that accounting is all about recording the transactions. Okay. Remember, if you have a business, you will be transacting a lot. So when you transact, it means you'll be engaging yourself with business activities, the financial activities. So transactions are going to be used in order for us to record in the books of accounts. So transactions are financial activities. For example, if your customer buys from you, that is a transaction. If you go and buy from the suppliers, that will be the transaction. If you go to the bank and ask for a loan, that will be a transaction. So the reason why we have got accounting is because we need to summarize those financial transactions or financial activities so that the users of those financial activities may be able to use them in order to make informed decisions. Remember, we compile these books because we want to satisfy the users. The users want to use the information in order to make decisions. For example, when we talk about the users, we talk about investors, the management, the employees, the customers, SARS, state, etc. So those people want to use the financial statements in order to make decisions. For example, let's make an example about me being employed. So I am the user of the financial statements of my employer because I've got that association with them. I've got the relationship. So I want to check if the business will be able to pay me my salary at the end of the month. I want to know if my fringe benefits will be able to be met at the end of the day. My security is at stake. So the financial statements will tell me whether the accounting books show the positive information or not, whether we make profit or not, whether we make losses or some, etc., etc. So again, accounting is very much important. Let's look at the elements of financial statements. Sometimes they are called the groups of accounts. Sometimes they are called the categories of accounts. Sometimes you can even call them classification accounts. Remember, in accounting, we are allowed to show off. So as long as it makes sense, you can call it as long as that way, if it makes sense. So these elements are very much important. There is no accounting without these elements. So at the end of the day, you need to master this, because this is the basic that we need. We need to make sure that we understand the meaning of these elements of financial statements. Remember, the financial statements are things like the income statement, the balance sheet, the statement of cash flow, the statement of changes in equity. Again, this will come at a later stage, okay? So in a nutshell, these groups are very much important. Let me explain this in simple terms. Assets are what you own. You have the private ownership of the assets. These are the belongings of the business. These are the possessions of the business. The business owns them. Okay, so we use the assets in order to run the business or operate in business. Liabilities. Liabilities is what you owe. So if I say I've got liabilities, it means I owe. The loan that you owe the bank, the account that you have with your creditors, you owe them. As long as you owe, that will be classified as what? Liabilities. Equity, we call it owner's equity. Owner's equity is the owner's interest in his business. In a nutshell, owner's equity is equivalent to the capital of the business. Remember, if you have you want to start a business, you need to put capital into the business, either in the form of money or in the form of assets. So those will be regarded as what? The equity. But we also have the other equity that is a negative, that has got a negative impact over the on the equity. For example, drawings. Sometimes the owner takes things from the business for own use. Those things will be classified as drawings. Those things will have a negative impact on the equity, on the capital. So drawings and capital are both equities, but capital is a positive owner's equity and the drawings will be the negative owner's equity. Why are we in business? We are in business because we need to make incomes so that at the end of the day, we can be able to make profits. Okay, so we need to generate more incomes so that when we compare our incomes and our expenses, we can make profit. Okay, for example, if you are selling grocery, so the sales from the grocery will fall under what? Incomes. If you are renting out your apartment, so that rental from your apartment will be under what? Incomes. But unfortunately, you cannot run the business without expenses. So those expenses again will increase. You have to pay the salaries, you have to pay advertising, electricity that is very expensive. So at the end of the day, for us to know whether the business is profitable or not, we'll need to compare the incomes and expenses. So the incomes must be more than expenses to show that we are profitable. But if our expenses are more than the incomes, it means we made a loss. Okay, so the result from incomes and expenses, either profit or loss, will affect what? Equity. Obviously, profit will affect equity positively and the loss will affect owner's equity negatively. Again, we need to understand all this. So you cannot run the business without expenses. Okay, so I hope that we are all following. Okay. Now, in accounting, we've got a system called double entry system. In accounting, we've got two sides. We've got debit and credit. So it means that for every debit entry, there must be a corresponding credit. That's why at the end of the day, the debits must always be equals to what? The credits. For example, let's say I buy equipment for cash. The two accounts that I'm going to have bank and equipment. So I'm going to record on the credit side of the bank and on the debit side of equipment. So in accounting, we don't record on the debit in one account and the other account we still record on the debit. No, we record on the debit in one account and the other one will be what? Credit. So you just have to make sure that the first account that you record in is correct so that you cannot use the double entry system and you still get an incorrect answer because of the wrong sides. Okay, but in a nutshell, the double entry system means for every debit there must be a corresponding what? Credit. Okay, again, please make sure that you study the notes. Now, this double entry accounting or system also satisfies what we call the accounts. So we call this a general ledger account. An account has got two sides, debit and credit. Okay, so this side, it means that on the debit side, it depends on the accounts because they don't behave the same. Some accounts increase on the debit side, some accounts increase on the credit side. So again, you must know this. You must know that an account always have the debit on the left and the credit on the right. So we're going to use a lot of this. So at the moment, just know that this account is called the general ledger accounts, but we're still going to talk about this more. Remember, for now, I'm just trying to summarize the theory for you so that by the time when we actively engage with the material, we are able to solve those questions. Okay. Now, it is important for us to understand the rules of accounts. Remember when we started there, I said we have got elements of financial statements. So there are rules, and then you must know those rules. Without rules, guys, you won't win. So what I did, because there are various techniques, there are various methods which can be used to understand the rules. A man of my caliber, as you can see here, I just grouped accounts according to how they behave. It's like your friends. So normally you choose friends because you think that you behave similar, and then you get along. So here, what I did, I had a box, and I put assets or assets. It depends how you call it, expenses and drawings. So all these groups or all these accounts behave the same. Everything in this box increase. This means increase on the debit side, and they decrease on the credit side. I can give you an example in advance here. Let's think about the bank. When you deposit money into your bank, it means your bank increases. Can you see? So if your bank increases, you must just come and check on this box. Okay, what is a bank? A bank is an asset. And you said that bank is increasing because you receive money in the bank. So under which side of the bank must you record? You will record on the debit side. Can you see now? So firstly, you must know where does that account fall. So, and thereafter, this will help you. But again, this will make sense by the time when we actively record in the books of accounts. The other remaining accounts, we've got capital, liabilities, and incomes. Again, I grouped them according to their behavior. Why am I grouping them? Is because I want to avoid learning these accounts one by one, because it's going to look like it's a lot of work. So everything in this box behaves the same. So when I write my exam, I can quickly put the boxes down so that when I start recording, I can keep referring. Okay. So this means everything in this box increase on the credit side and decrease on the debit side. Okay. So I just want us to try this method. If it doesn't work for us, we can use other methods. But based on my past accumulated experience, I've realized that most of my students understand this method. There are other methods like the debt click, like the accounts, things like the T, using the T account plus minus. So for me, I choose this one for now. If it doesn't work, guys, we have got option of using the other techniques. Now let's have a look at the definition of the assets. I just try to give you more. Can you see? You can also engage with the prescribed material. Like I said, assets are things you own or resources a business owns. They are controlled by the equity. They result from the past event, meaning you must first buy an asset before it becomes a. So it's past event, past activity. Expected inflow of future economic benefits. Why do we buy assets? For example, I like investing in property. So if you invest in property, so in other words, it means I need to buy the property first, meaning that property is a past event because I bought it. And then now this property, I expect it to give me incomes in the future, maybe in the form of rent or maybe in the form of sales. So that's why I expect the inflow of in future economy. This is just a formal way of explaining it, but in a nutshell, an asset is what you own. Okay. And again, we need to understand that the assets have been divided into two. The assets have been divided into non-current assets and the current assets. Non-current assets means long-term assets. Current assets means short-term assets. So again, you must know that assets have been divided into two. Okay, long-term assets and the short-term assets. Okay, Now, let's have a look at the examples of the non-current assets. There are too many. We've got the land, we've got land and buildings, machinery, equipment, motor vehicles, furniture and fittings, investment. I just gave you some examples. Can you see? These are like, we normally call them fixed assets. Okay? If a man of my caliber wants to show off, I also call them the tangible or tangible assets. Okay? These assets are not sold. They are used to sell other things. Can you see? Think of a college or think of a university. Does a university sell land and building? No. They keep land and building to offer those classes to the student. So they are fixed assets. They are there to sell other things. Hopefully it makes sense. Now, examples of the current assets, these are the short-term assets. They are liquid enough. Okay, so as you can see, I've got the bank. Can you see? A bank keeps changing, it changes like nobody's business. The cash float. What is a cash float? A cash float is the money that you use for small change in the business. Petty cash. Petty cash is the money that you use to buy small items, like you are buying an envelope, you are buying sugar for the staff, things like that. We use petty cash. So we don't normally use petty cash for like to pay salaries. Just imagine you are paying Sylvester, a man of his caliber, out of petty cash, and in the petty cash, remember, normally the maximum is 1,000 or 5,000. Can you see? It's like I said, an insult by paying me with that, So I'm just saying, but at the end of the day, we understand the account. Debtors controls, people that owe us, those who bought from us on credit, the SARS, the trading inventory that you sell, there are two examples, but please, at the end of the day, you need to go and engage with the material so that you can be able to understand better. Let's talk about the liabilities now. Remember, it's what the business owes. There is a present obligation, meaning you are obliged to pay back that particular amount of money. Again, we can only have a liability if something happened in the past. We must first transact on credit, and thereafter I will start owing you. Okay, but as you can see, this is just a complete opposite of an asset. The expected outflow, in other words, we are going to pay money. That's why we expect to pay the outflow. Unlike assets expected inflow because we use the assets to get cash at the end of the day. Okay, again, this have been divided into what? Two. So sorry, I just missed it. This is the non-current liabilities. Non-current liabilities, meaning the long-term liabilities, things like the mortgage loan and the bond. Like if you buy a house, they give you a loan, the bank gives you a loan, so that loan will be the long-term liability or non-current liability. Even the loan itself, you can go to the bank and ask for a loan for 200,000 and you pay it over 5 years or over 10 years, so that long-term loan will be non-current liability. The loan that is going to be, it's not going to be paid in the next 12 months will be classified as what? As the long-term loan or the non-current liability. We also have the current liabilities under liabilities. For example, the bank overdraft, the creditor, SARS when we owe them, the credit card. Again, guys, you must be able to give us the examples. Please, again, engage with the material. But as the time goes on, when we solve some questions, I'm going to bring more accounts so that you can be familiar with. Okay, so for now, remember, we use this opportunity to understand the theory. So this video will help you a lot. If you don't follow, please keep posting so that we can get the picture at the end of the day. Let's talk about the equity. Like I said before, equity, same as capital at the end of the day. So rights of the shareholders or their claim on assets. So if I invest in the business, it means I invested the equity. So I've got the interest in the business. I think the word interest you are familiar with, even with the government, they say the members of the parliament must disclose their financial interest. Can you see about this thing of a tender processes? Can you see now? People are getting tenders because they've got interest. Can you see now? So if you've invested in the business, it means you've got the financial interest. Is the residual value? What do I mean? Is the difference between the assets and the liability. So when you take the assets and you minus liabilities, you get what? Your equity. Again, let's look at the examples. Like I said before, we've got capital and drawings. Remember, this drawings is a negative item and capital is a positive item. By the way, drawings means the owner took things from the business for own use. And again, capital, remember, is not all about money. Even if I can start the business with the building, that building will be part of the capital. Can you see now? Anything that comes from the owner as a contribution to the business will be classified as capital. Let's talk about the incomes. Remember, these are the inflows or benefits in exchange for providing goods and services. Yes, they increase owner's equity. You must know this because when we deal with the account equation, it's going to affect us. So again, they increase profit. So the more incomes I have, the more profits I have, and the owner's equity will be increased. Okay, and they are inflows. Can you see? And then these are the examples: less sales, revenue, services rendered, rent income. Can you see, guys? So make sure that you go through all these accounts. Okay. Expenses are just complete opposite of incomes. Okay, when the resources are consumed in order to generate income, outflow. Can you see now? Incomes were inflow, expenses outflow. For example, telephone accounts, things like that. They decrease owner's equity. Again, know this, they will decrease owner's equity. The more expenses I have, the lesser the owner's equity. These are the examples. Can you see there are too many? I just gave you some examples. Again, more examples will be encountered by the time when we actively engage with our learning material. Remember, this is just, again, I repeat, to summarize these things. We go through them, guys. We're gonna learn more in the near future. Now, I want us to talk about the accounting cycle. Remember, in accounting, there's a cycle. There is a process in accounting. And the process of accounting, if you can check, in most cases, is the same as the chapters of a particular prescribed book. Okay, so this is just like a chapter. Chapter 1 can be transaction, chapter 2, but this is accounting cycle. So accounting starts with the transaction. What do I mean by saying transaction? A transaction is a financial activity. Okay, so it means when I go to the bank and say, may I please have a loan? If the bank grants me a loan, that is a transaction. If I go and buy something from an outlet, let's say I buy shoes, that is a transaction. If I go to the canteen and buy some food, that is a transaction. So a transaction is a financial activity. The reason why we've got accounting is because of the transactions. We need to summarize them. We need to record them. We need to make sure that they are well processed so that they can be useful to the users. Remember, users can be managers, they can be employees, they can be SARS. Anyone who is interested in our books is called the user. Okay, but after the transaction has taken place, we need to have the proof for that transaction. Things like invoices, things like receipts, things like check counterfoils, things like general narrations. So those proofs of transactions are called source documents. Normally we put them in the file so that we can refer to them in the near future. So we put them in the file and we use this source document to record in the books of account. Because if we cannot have source document, how will you know that the transaction has taken place? When you go and withdraw money from the bank, you also need what? Source document, because you want to make sure that that particular transaction is reflected on the bank statement. Even the bank statement is a source document. After having the source document, is then that we start recording. If you're a bookkeeper or if you're an accountant, you will see that you take information from the source document and you record in the books. Where do we go from source documents? We go and record under subsidiary journals. Subsidiary journals are also called books of first entry, books of prime entry. This is the stage where we first record the information about the transactions. Okay, but we take the information from the source document. Let me give you an example. Sometimes we sell on credit, sometimes we buy cash, sometimes we sell cash. Can you see the transactions do not behave the same? So this means that, for example, if I received cash, there must be a book only for cash received. If I paid cash, there must be a book for only cash payments. If I sold goods on credit, there must be an account for selling goods on credit. If I bought goods on credit, there must be an account for buying goods on credit. If, for example, let's say I returned goods to suppliers. There must be a specific book for returns to the suppliers. So those books are called subsidiary journals. Again, we're going to learn more about them thereafter. I hope you are following. Now, after drafting the subsidiary journals, where do we go from here? We go to what we call the general ledger accounts. Let me go back again to subsidiary journals. Remember, let's say, for example, I bought equipment for cash, meaning equipment will be reflected under a book where I record all the payments which I made for cash. Because I bought that equipment, is now that I'm going to open an account for equipments only. Can you see now? So the minute I open the account for equipment only, we call that account general ledger. I can open equipment account, land and building account, bank account, telephone account, advertising account, data control account, creditors control account, etc. So those accounts are called general ledger accounts. After compiling the general ledger accounts, is then that we must transfer the general ledger accounts, because we're going to balance those accounts one by one. We're going to transfer them one by one to what we call the trial balance. And the trial balance must balance. A trial balance has got a debit and a credit, meaning the debit side must be the same as the credit side. Okay? But what is the main function of the trial balance? The main function of the trial balance is to check the correctness of the general ledger account. So if your general ledger account is not properly drafted, your trial balance in most cases won't balance. Why do I say most cases? It's because sometimes the trial balance balances with the wrong figures. So when you balance the trial balance, please do not organize a street bash and celebrate. You can be disappointed. It can balance with the wrong balance. For example, you can make an error here, maybe under the subsidiary journals, and also make an error under general ledger. So the one error can compensate one error, and the trial balance can end up balancing with the wrong figures. So you must double check. That's why I've got auditors who go through the process. They check the flow of transactions to the source document, from the source document to the subsidiary journals, from the subsidiary journals to what? To general ledger. So they make sure that everything is well prepared. After the trial balance, our last stage is called financial statements. Remember, this financial statements is where we are going to know whether we are profitable or not, whether we are in a good financial position or not. Okay, so managers normally like the financial statement because this is where we can see the performance of the business. Here is where we can see the financial status of the business. So all the information from the transaction up to trial balance will be summarized under financial statements. For example, financial statements are income statement, also known as statement of profit and loss and other comprehensive income. We've got the balance sheet, also known as statement of financial position. We've got the statement of changes in equity. We've got the statement of cash flow. So those statements are very much important. But unfortunately, you cannot have those statements without following the process, because the information that has been recorded through the process is the one that is going to be used in the financial statements. I hope that you are following. But what is the difference between the bookkeeping and the accounting? As you can see, the whole process up to financial statements is called accounting. But the process from the transactions up to trial balance, it is called what? Bookkeeping. So those are just the difference between the two. So the whole cycle up to the financial statements is called accounting. But when you end up to trial balance, it means you are dealing with what? Bookkeeping. So make sure that you understand this better. Okay. I hope everyone is following. Now, there's something that is called account equation. So account equation, again, all those accounts that we talked about will be coming to this account equation. As you can see, this is an equation. Assets are assets equal to owner's equity plus liability. I know you did a little bit of mathematics. You know this is an equation at the end of the day. But please don't disappear. This is not mathematics. This is accounting equation. Okay, we need to make sure that whenever we deal with the books, we satisfy this equation. I call account equation a shorter version of a balance sheet. Because even in the balance sheet or statement of financial position, we record assets, owner's equities, and liabilities. And again, the first section of statement of financial position or balance sheet is assets, and thereafter the other two sections will be what? Equity and liabilities. So we need to understand this at the end of the day. Can you see? We need to understand what are the assets, what are the owner's equities, what are the liabilities. That's why I did give you the examples from the previous slides. Okay, but what you can see here, there are three groups which are missing here. Think about it. So those groups are incomes and expenses. So incomes, expenses, remember, and expenses, I told you that they affect owner's equity. So when you record incomes under equity, they will have a positive impact, but when you record expenses under equity, they're going to have a negative impact. Again, we're going to unpack this by the time when we actively engage with the material. So for now, let's make sure that we understand the equation. I can also give you a practical example. Let's say I want to start a business and I only have 5,000 to start the business. And my assets are what? Are 12,000. But I only have what? 5,000. So it means with the 5,000, I cannot be able to buy all the assets. So that 5,000 will be regarded as my owner's equity. But I can go and negotiate with my liabilities. Maybe I can go to the bank or negotiate with my creditors and say, please, can you give me a loan, for example, of 7,000, so that when I take this 7,000 plus 5,000 that I have, I will be able to buy the assets of what? Of 12,000. Can you see? This is an account equation. It's like you going for a metric dance. At home, they just gave you only 10,000. And then you want to buy, let's say, a dress and then the shoes for, they gave you only 10,000, and the dress and the shoes are 15,000. But you really need those things. What you can do, you can go and say, okay, negotiate with the store manager and say, can I give you 10,000 and the remaining 5,000 I'm gonna pay you per month for 5 months. Can you see now? So now you initiated a liability. So that liability plus 10,000 will be able to get you what? Your assets in the form of a dress or trouser or shoes. Okay, I hope that everyone understands. Please make sure that you engage more with the material, and then I will see you soon. And then please check your VC so that we can be able to interact on a regular basis. Okay, thank you very much, guys. This is the end of our learning unit. So let's make sure that we understand this. Okay, so this is the learning unit number 1, not 2. So the learning unit number 2 will come thereafter. Thank you very much, guys. Have a nice day, and please access the video as soon as you can. Thank you very much. I really appreciate, guys. Have a nice Monday.